Welcome back to Talk Tickers. This is the show where we ignore the cable news panic, strip away the corporate jargon, and hunt for the actual signal in the financial noise. Today's January 31st, 2026, and we are cracking open the books on a company that is likely sitting in your bathroom cabinet, your kitchen sink.
And possibly your dog's bowl.
Exactly. We were doing a deep dive into Colgate-Palmolive, ticker symbol CL.
The ultimate defensive stock. I mean, it's toothpaste, soap, and kibble. It is the definition of, a boring business.
Right.
But sometimes boring is exactly what you need.
Boring might be the reputation, but the market reaction this morning was anything but. The stock popped a massive 5.96%, closing above $90.
Wow.
And honestly, looking at the headline numbers, I found myself scratching my head a little bit. Because if you look at the official accounting, the GAAP numbers, Colgate actually lost money this quarter.
Right.
They posted a loss of 5 cents per share.
It does look like a massive contradiction at first glance. You have red ink on the bottom line, but a massive green candle on the stock chart.
Exactly. So our mission today is to decode that disconnect. Why are seasoned portfolio managers cheering for a loss? And we've got a very specific, slightly unhinged trade idea at the end.
Oh, I'm looking forward to that one.
It plays on human vanity versus dog loyalty. But let's start with that loss. Walk me through this. How does a company sell over $5 billion worth of soap in 3 months and still lose money?
Well, it comes down to the difference between operational reality and accounting reality.
Okay.
The operational reality, what they call the base business, was actually fantastic. They beat earnings expectations by 4 cents, coming in at 95 cents a share against a 91-cent target.
So solid beat.
A solid beat. And revenue was $5.23 billion, which was also a beat. So the engine is running fine, but the accounting reality got hit by a truck.
And that truck was the impairment charge.
Right. A $794 million non-cash impairment charge.
Okay, I want to pause here and push back on this because we see this game played all the time on Wall Street. Companies strip out the bad stuff, they call it one time, and tell us to look at the adjusted numbers. Is this just financial engineering? Is that nearly billion-dollar loss just management trying to hide a mistake?
That is the right question to ask. And the answer is yes, it is them hiding a mistake, but it's a mistake from the past.
Okay.
This charge is entirely related to their skin health business, specifically the Filorga brand and their operations in China.
Premium skincare bet.
Exactly. A few years ago, there was this gold rush mentality. Everyone thought premium skincare in China was an infinite money glitch. Colgate bought into that thesis, and they bought in heavily.
Right.
What happened this quarter is management effectively standing up and saying, we were wrong. We were too optimistic. This asset isn't worth what we thought it was.
A confession.
It's a positive confession. By taking the charge now, they're clearing the decks. Investors hate uncertainty much more than they hate bad news. If they hadn't taken this charge, every earnings call for the next 2 years would be dominated by questions about this dragging skincare business. By writing it down, they're essentially saying, we've sized the failure, we've booked it, and now we move on.
So the market rallied because the uncertainty is gone, even though the money, or at least the asset value, is gone too.
Precisely. And remember, it's a non-cash charge. They didn't write a check for $794 million yesterday. They just admitted their stuff isn't worth as much.
Okay.
The actual bank account tells a very different story.
Let's talk about that bank account because the cash flow numbers were startling.
They were incredible. Operating cash flow for the full year 2025 was a record $4.198 billion.
That is a lot of cash.
It's a machine.
Yeah.
And that is the signal the market is trading on. You can have accounting losses, but if you are generating $4.2 billion in cash, you can pay dividends, you can buy back stock, and you can invest in advertising.
Right.
That cash flow proves the core engine is intact.
Okay, let's look at how they generated that cash, because the composition of the sales growth is really interesting. Top line revenue up 5.8%. But they talk a lot about organic sales. Can we just briefly unpack what that actually means?
Sure. Net sales is everything thrown in a pot. But that number gets distorted by things like acquisitions and foreign exchange. Organic sales strips all that noise away. It just asks, did you sell more toothpaste to more people at a better price than you did last year?
It's the health of the brand itself.
Exactly. It's the core health.
Got it. So organic sales were up 2.2%. That feels fine. You know, it's not exactly tech growth.
It's solid for a staple, but you have to look at the levers they pulled to get there. Organic growth comes from two places, volume or price.
And looking at the breakdown, pricing was up 2.7%.
And volume was roughly flat.
Flat volume doesn't sound like a victory. I mean, usually you want to sell more units.
In 2026, flat is the new up. Seriously. We are in an economic environment where the consumer is incredibly fragile. We have seen other consumer staples companies report volume declines of 3, 4, even 5%.
Because they pushed price too hard.
Exactly. The consumer balked. Colgate raised prices by nearly 3% and held their customer base steady. That is the definition of pricing power.
It means I'm grumbling about the price of the toothpaste, but I'm still putting it in the cart.
You're still putting it in the cart. You aren't trading down to baking soda just yet.
Okay, there was another number in there that stood out to me as bizarre. Foreign exchange, or FX. Usually, for a massive U.S. multinational, a strong dollar is a headwind.
Always.
But this quarter, FX was a massive tailwind. It added 3.1% to growth.
This is a total unicorn sighting. It has happened maybe twice in the last decade.
Why? What happened?
Essentially, the U.S. dollar softened slightly against a basket of key currencies, specifically the Mexican peso and the Brazilian real during the quarter. So when they converted those pesos back into dollars, they got a bonus.
It's free money.
It's a gift. But, and this is key, management was very smart to frame this, they know it's temporary. They aren't banking on the dollar staying weak.
Don't get used to it.
Enjoy it while it lasts, but don't build your budget around it.
Okay, so we talked global numbers, but I want to zoom in on the map because this wasn't a victory lap everywhere. There is a real tale of two markets happening. And the North American numbers, our home turf looked pretty ugly.
Yeah, they did.
Organic sales were actually down 1.8%.
It was definitely the weak link. The U.S. consumer is behaving very differently than the consumer in, say, India or Latin America right now.
Management used the phrase pantry destocking, which I assume is polite corporate speak for people are broke and using the last drop of soap before buying a new bottle.
That is exactly what it is. It's stretching the purchase cycle. But there is something deeper happening here called bifurcation.
Bifurcation, a fancy word for splitting in two.
Right. The market is splitting. You have the high-end shopper who is still buying the premium $10 whitening toothpaste. But the value shopper is under immense pressure, and we're seeing a trade-down effect, but only in specific categories.
What do you mean?
They specifically called out dish soap and fabric softener as the problem areas.
Why those specifically? Why not toothpaste?
Well, think about the psychology. Nobody sees your dish soap. It's a utility. If you are tight on cash, you will readily swap the Palmolive for the generic store brand to save a buck.
Right.
But toothpaste, deodorant, those are personal. They are on your body. There's a fear of failure there. You don't want bad breath. So people remain loyal to the premium brands for personal care, but they cheap out on home care.
So the invisible products are suffering, but the vanity products are holding up.
In the U.S., yes. But then you flip the globe to Latin America, and it's a completely different story. Mexico and Brazil are absolutely booming.
Just on fire.
High single-digit growth. Colgate is dominant there. It's not just a brand. It's, it's the generic word for toothpaste in some places. That moat is holding up.
Let's pivot to the third pillar of this company. We've done oral care. We've done home care. We've talked about the pet business. Hill's Pet Nutrition.
A secret weapon.
But looking at the macro data, the pet category overall is soft. We had that massive pandemic puppy boom.
Mm-hmm.
Now, adoption rates have plummeted. There are literally fewer new dogs to feed, yet Hill's grew volume by 2%. How are they defying gravity?
They made a very bold strategic move. They essentially fired their bad customers.
Explain that. How does firing a customer increase volume?
So Hill's used to dedicate a lot of their manufacturing capacity to private label production, basically making dog food for other brands.
Okay, low margin stuff.
Tiny margins. Management decided to exit that business entirely. They cut off that empty calorie revenue.
So they freed up factory space.
They freed up the factories to make more of their own brands, specifically the prescription diet.
The stuff the vet tells you to buy.
Right. The kidney support, the weight management. That bag of food costs $80, not $20. The margins are spectacular. So they traded quantity for quality.
And it's working.
It's working. They're gaining market share in the premium space. They also highlighted the acquisition of Prime 100 in Australia, which is performing ahead of plan.
A fresh food brand.
Yes. It proves that even if people are trading down on dish soap, the humanization of pets trend is bulletproof. People will eat ramen noodles themselves before they let their dog eat generic kibble.
which is a perfect segue to the trade idea we have coming up. But first, I want to touch on the future. They talked about moving to Project 2030. Is this just a new PowerPoint deck, or is there real substance here?
There is a distinct shift in how they view the battlefield. The buzzword is omni-channel demand generation. But here's what it actually means. For 50 years, Colgate won by dominating the physical shelf.
The wall of red.
The wall of red. You walk into a CVS, you can't miss it. But today, the shelf is an algorithm on Amazon. It's a banner ad on TikTok. They are realizing they have to win the digital shelf.
And they gave a specific example of this in China.
Yeah, with the Holly and Hazel brand, it was struggling. So instead of discounting it, they went the other way. They went premium. They introduced dual chamber technology.
That sounds like something from a SpaceX rocket, not a bathroom sink.
It's brilliant packaging. It's a tube that keeps two formulas separate until you squeeze it. It looks scientific, it looks premium, and it justifies a much higher price point. It gives the consumer a reason to pay more.
Okay, so speaking of the future, let's look at the guidance for 2026. This is the roadmap. Net sales growth of 2% to 6% and organic sales of 1% to 4%.
That is a remarkably wide range for a stable company.
It is. Usually you see a tighter band. Why so wide?
It's not ambiguity, it's honesty. Management essentially said, look, the world is a mess. If the U.S. recession fears come true, they hit the low end. If things stay stable, the middle. If the economy improves, the high end.
So they are not betting the house on a recovery.
No. They explicitly stated they are not banking on a big rebound. They are preparing for a grind.
And they addressed the tariff elephant in the room, too.
They took a very pragmatic stance. They said their guidance includes tariffs that were announced and finalized as of January 28th. So they aren't speculating, they're booking reality.
So bringing it all back, the stock pops 6% on a GAAP loss. The thesis is just safety.
It is the boring is beautiful thesis. In a market where tech stocks swing 20% on a rumor, investors look at Colgate and see a fortress. It generates record cash. It pays a dividend that has increased for 63 consecutive years.
Wow.
Even if they have to write down a bad acquisition, the core engine, the toothpaste, and the dog food is bulletproof.
It's the stock you buy so you can sleep at night.
Exactly.
Okay, sleeping at night is nice.
But we promised the listeners we'd wake them up. It is time for our Not Financial Advice segment.
Let's get irrational. Disclaimer. We are not financial advisors. Do not do this. This is for entertainment purposes only. Imagine we are hedge fund analysts pitching the investment committee. What is the play?
Okay, I've been thinking about this. I call this trade the vanity versus fluffy arbitrage.
I love it already. Break it down.
Look at the data points. What crashed? Premium human skincare. Filorga. The skin health business took a massive write-down. Why? Because when consumers feel poor, they give up on the expensive anti-aging cream.
They let themselves wrinkle.
Harsh but true. But what held up? Premium pet nutrition. Hill's. The fresh meat rolls. The logic is this. Humans will sacrifice their own vanity, but they will never sacrifice their dog's health.
The dog is the last thing to get a budget cut.
Never. Fluffy gets the science diet. So the trade is...
Let me guess.
Short the mirror, long the leash.
Walk me through the execution.
You go out and you short a basket of pure play luxury skincare equities. You bet that the weakness Colgate saw in Florida isn't a Colgate problem, it's a macro trend. And you pair that with a leveraged long on pet health and nutrition stocks, you are betting on the emotional leverage of the pet owner. It is the ultimate defensive pair trade for the modern consumer.
I have to admit, looking at my own bank statement, I canceled my gym membership last month, but I just bought my dog an orthopedic bed.
See? The thesis holds. The emotional moat around the dog is stronger than the moat around your own face.
It is wild, it is dangerous, and it is based on deep psychological truths. I love it.
Yeah.
But again, please don't actually do that with your retirement money.
Please don't.
So to wrap this up, Colgate-Palmolive delivered a core engine intact quarter. The GAAP loss was just a cleanup. The cash flow is massive. The dividends are safe.
And the market rewarded them for ripping off the Band-Aid on the bad news while delivering the goods on the base business.
Before we sign off, I want to leave you with one final provocative thought. We talked about skin health failing and pet health soaring. But if you look at Project 2030, Colgate is investing heavily in science-based oral care.
The medicalization of the bathroom?
Exactly. My thought is this. Are we moving toward a world where beauty marketing dies and everything becomes health marketing? Maybe their skincare failed because people stopped believing in beauty promises and only trust health diagnoses. If Colgate can turn toothpaste into a medical device, they win. Watch the packaging next time you shop. Is it selling a smile or is it selling a diagnosis?
That is a fascinating shift from look good to don't die.
On that cheerful note, next time you're in the grocery store, check the dish soap aisle. Are people reaching for the store brand instead of the Palmolive? We want to know if the trade down is happening in your neighborhood.
Real-time channel checks. We love those.
Hit us up on social media and let us know. Thanks for diving deep with us on Talk Tickers. We'll catch you on the next earnings print.
Stay curious.